Shares of Chewy jumping on the back of an earnings beat and a revenue beat. Before he hops on the earnings call, let's bring in Chewy's CEO, Sumit Singh. Shares are up 4% right now, I should add. Sumit, it's great to have you on. You talk about it here in the release that Chewy once again gained share. Where did you gain share? How did you gain share? And what did that mean in terms of how consumers are spending money on their pets and interacting with the company and the site?
Hi, Morgan. It's nice to be here. So you're exactly right. We delivered 14+% revenue growth year over year, and that's a shared leading performance on the back of an industry that grew, I would say, mid to high single digits in Q2. And if you look at the consumer right now, the story hasn't changed much from Q1, other than the fact that the consumer is slightly more discernible coming out of the Q2 quarter. So we continue to drive outsized performance in healthcare and in consumables that drove roughly 85% of our sales. And then two, if you are familiar with our Autoship subscription product, that product drove over 3/4 or 75% of our net sales in the quarter. So as a result of these two, what you're essentially noticing is high levels of consumer engagement with platforms like ours that makes up for the sales beat.
Yeah, a lot of focus from Wall Street analysts coming into this report on active customers, not only in terms of growth and the numbers, but also in terms of how much those customers are actually spending. I guess walk us through how the quarter did and where folks, I mean, just talked about healthcare, for example, but where folks are spending.
Yeah, so this is really compelling about the way consumers engage with our platform. If you look at a metric called share of wallet, or we call it net sales per active customer, that metric, as you can see on the screen, was up about 15% year over year. So we grew share of wallet to reach $530. And from the time of our IPO in 2019, this is up 60%. We were at $300+ in 2018, coming out of 2018. So consumers, when they interact with our platform, they spend healthy levels with the way that we drive our penetration into our health categories, which might be prescription food or medication. But at the same time, they get this great assortment or wide assortment to choose from in us serving their food needs, whether it be premium or all the way to value segments if you're a more value conscious customer per se. We're also pretty great at driving attach rates. So while hard goods on an overall basis is down, we're seeing some signs where hard goods categories that are much more consumables or consumption based are essentially driving some attach for us, which is obviously encouraging to see. So broadly, we're pretty satisfied coming out of the quarter.
So that makes me wonder if we're seeing you have sort of the Walmart effect in pets here, where because you've got that essential category of food and you've got Autoship and you've got that loyalty going, that's helping you to gain share from others. Is that fair?
So, John, you're onto something here. Today, consumer is looking for they're looking for value and convenience. It's not enough to offer just value or just convenience. And so I think consumers are declaring their retailer of choice. And when they find the platform where they can essentially extract value and convenience, which they're doing at Chewy, they just double down. So when you look at our consumer engagement or our AOVs or basket sizes, they've essentially held steady to increasing incrementally on a year-over-year basis. So I think the insight that you're getting at is essentially right.
Interesting. Okay, so tell us what this means for gross margins. They were 28.3%, up 20 basis points year over year. You have been increasing margins, but as this inflationary pressure on this consumer continues, do you have to continue to shift into Autoship in order to maintain margins? What helps you to continue to maintain and maybe even improve margins from here?
Yeah, so we have many different irons in the fire, or many different strengths that essentially in the way that we go to market with our consumers. So Autoship, for example, that drives 75% of our revenue, is a net low-cost mechanism for us to be able to fulfill that volume. Because think about it, you're much more efficiently forecasting, you're much more efficiently fulfilling that product, through our fulfillment centers. Two, we've invested in supply chain transformation over the last 3 years. So coming out of the pandemic, we're a stronger company as it comes to supply chain and operations. And that provides tremendous leverage to us as we kind of bring down sales all the way through our freight line into our fulfillment centers per se. So it's a combination of growing high margin verticals like health, high accretive products like Autoship, and then investing behind supply chain and operations transformation.
Quickly, Sumit, do you have any news for us on a CFO situation?
Well, we have lots of tremendous incoming demand, and we're being highly diligent and deliberate. So I'll come share with you when I have the next good news there.